Good morning, good afternoon, good evening to everyone. Thank you for joining us today. My name is Jeff Boccaccio. I'm a member of the STA's Board of Directors. That's the Society of Technical Analysts. And so the STA is hosting the event this evening as part of one of our usual monthly events. And tonight, of course, we're joined by Larry Williams. Hi, Larry.
Hi, Jeff.
So I got to say, I've been looking forward to this chat for a very long time, but I have to pause for 1 second because I've just got a couple little housekeeping items that I want to cover first. We've invited a bunch of guests along today as well, so some people aren't as familiar with the STA, so just a real brief intro. The STA is a not-for-profit organization that focuses on promoting and educating basically all things technical analysis. We try to hit the highest standards, and we've been doing so for over 50 years. We offer courses, there's live courses, or there's home study flavors. There's also exams which can earn you a professional qualification, and you can become an associate member, allowing you to come along to the meetings like these ones that we have every month. Half of the time they're in person in London, that's where I am. And that way we get to have some drinks afterwards and that sort of thing. And then the other half of the time we get to talk to guys in far-flung locations like Larry, for example. So tonight we're essentially back on our international tour. It's like our Ask the Expert series is kind of what we've been referring to it as. My last piece of housekeeping is Q&A. So if you have questions, please drop them in the Q&A box as opposed to the chat. It's just easier for us to manage, and we're more likely to find them. We'll do our best to get to as many questions as we can. Apologies in advance if we can't get to them all. We need to be respectful of Larry's time here, really. Now, like I said, I've been looking forward to this chat for quite a long time. I don't think Larry needs any introduction or much of an introduction, but I'll give you a little one anyway. So trader for, I'm going to say, over 50 years. One of the biggest things to me is that Larry puts his money where his mouth is. So he is actually trading, and I love his website, ireallytrade.com. And he is a best-selling author of numerous books, and not all those books are about trading, FYI. He was on the board of the NFA, that's the National Futures Association in the US. He's won numerous awards and much more that I hope that we can sort of uncover through our conversation today. So just as we get started here, there's a slight danger of reinforcing some common trader stereotypes. And that's because Larry's coming to us from the Caribbean today, the US Virgin Islands. And so really, I guess all we sort of need, I'm a little bit concerned that you're going to wheel out, a bright green Lamborghini or something to just kind of complete that sort of trader picture stereotype. But thank you so much for joining us, Larry.
Jeff, thanks very much for having me. I'm always flattered to think that anybody would invite me to come talk about the market. So it's always really intriguing and something I enjoy.
Man, I'm like I said, I'm sure we could talk all day long. But well, our audience is primarily technical analysts. We've got some quants, we've got traders, we've got fund managers. So I figured we should start by talking about running. What do you think?
Oh, sure. Why not? It's like trading is painful.
It's painful. And I think I've heard you say before that it requires training.
It does. You don't get good at any athletic event instantly. I think that's very similar to trading. I didn't start making money the first day I started trading. I don't know that anybody does, or they'll lose it shortly thereafter. So yeah, yeah. And frankly, Jeff, I'm still in training to trade, as well as for some athletic things as well. This last summer, I qualified for the Senior Olympics in a couple of events, and that took a lot of training. And so I continue to train both my mind for trading and my body because I want to be healthy.
So I gather that you've been a runner for quite a few years, and possibly as long as you've been trading. Do those things go hand in hand for you in any way?
That's interesting. I hadn't thought of that before. I started trading in 1962. I was at the University of Oregon, And one of my roommates, well, actually two of them ran in the Olympics. So I can't say I ran with them. I tagged behind them, I think would be a better way of putting it, because they were really good. But I ran, and I started doing it, so from 62 forward. Yeah. Wow. I didn't realize there's clearly a parallel in my life there.
Yeah. Well, I mean, I'm a runner, but I probably not to the same extent as you, and certainly not to the same extent as your roommates. But I find it's a nice way to break up the trading day, get out of your own head sometimes when you just need that bit of distance from, charts and markets. And it's a way to almost sort of switch off and focus on something else for a bit.
Yeah, you can't focus on the markets when you're, in my case, I like to fish as well, I like to fly fish. I can't focus on the markets and think about my casts or what I'm doing. And right. When I'm running, I've been trying to learn to high jump and hurdles this year, and actually about the last 3 years. And you just can't think about the markets when you're doing that. So it's very refreshing. It's like a break. It's like a Zen experience. Because otherwise, this market's in my head all the time. I can't get it out.
Yeah.
But I do something intensely physical, it disappears, it's gone.
Yeah. Yeah. So in a way, it's a form of rest. Yeah, I totally understand that.
But I have to admit, in a couple of marathons, I remember in the old days, taking money with me so I could call my broker from along the way in a marathon to see. I've done that.
Brilliant.
Of the 80 marathons they ran, I think I did that in 3 of them. I had big positions on, and I was like, I didn't know what was going on.
Wow, that's good. That's dedication, right there. You're going to sacrifice a few minutes to make a call.
I think that was probably it. I needed a break.
So I've heard about these rock and roll marathons. Were those some of them?
Yeah, that's something interesting. 6 of us founded the rock and roll marathons, which are now literally all over the world. The founder just passed away recently. But we were the investors in it. We thought for sure we would lose our money, but we enjoyed marathons, so we invested in it. And it actually ended up being one of the best investments I've ever made. It was incredibly successful. We raised $300-400 million for charities with the rock and roll series.
Fantastic.
Really big. And eventually, it was bought out by the people who are Ironman, so we're no longer involved with it.
Wow. What a great legacy, though. And so was the idea behind the rock and roll marathons? Well, what was the idea? Is there rock music playing the whole way, or?
The original idea was Tim Murphy's, the gentleman who just passed away. Tim and Tracy Song kind of put the idea together. Marathons up to that point could be really boring at points, and there wasn't any to keep your mind involved. So that, well, let's have a rock and roll band at every mile marker. And so we did, and that just changed running. And it was at a pivotal point, because marathons, triathlons are not as popular now as they used to be. Running was shifting from I want to do my PR and do really well to let's make this an experience. And the rock and roll concept was going to make this a really unique experience. We'll do it in unique locations. San Diego, the music marathon in Nashville, Tennessee with country western music, and have something fun along the way. So it's like a party out there. There's a lot of good vibrations in it. And that was the idea. Incredibly successful.
Excellent. So now trading can be a bit like a marathon, right? And there are periods of hardship and boredom within trading. So is there anything that you do that would mimic having a rock and roll band every mile marker?
Maybe. I will drink a couple of cups of coffee in the morning to get me going. In part, I'm 80 years old. So how do I got to jumpstart my mind and my body. So I'm like, okay, let's take it on now. So that might be one thing I do. I don't follow the market intensely intraday. Yeah. At this point in my life, I have positions on, and I'm willing to give those some time. So I'm not as intense as when I was young. I think that's just a natural evolution that you go through. I think I know a little bit more about the markets now, so I'm not worried about a little tick here and tick there. I'm not worried about that. I have a pretty good idea what's happening. But certainly the ability to deal with pain, because I've been in some very, very painful positions in the market, and to get through it, to know, hey, there is an end to this thing. It will be over, the marathon or the bad trade or the good trade. The good trade can be painful too, because you make a lot of money and you're afraid you're going to slip back and lose some of it. So there's pain. There's always pain in this business.
Right.
Always.
Well, I mean, I think I've heard you talk about the manic sort of depressive nature of markets, and then what it can do to you or all of us as traders as well. And so I could see that you could use running as a way to sort of even out that keel, to sort of like keep you a little bit maybe more emotionally bound. But yeah, I mean, are there other ways that you manage those painful periods that you mentioned, like when you've been large positions or when it's just been against you for a while?
Yeah, good red wine. But actually, there's an interesting point I want to make about that. My son's a psychiatrist trained at Johns Hopkins University. And Jason did a study of just successful traders. Prior to his work, people had done studies on losing traders to see what they had in common. Jason did just successful traders. Friends I know, people that are billionaires, and incredibly successful traders. And really interestingly found out about that point was that these people, emotions don't swing very much. They go, maybe mine go like that and theirs go like that.
Right.
These great traders just don't get emotional about anything. And I think that's one reason why they have a better control. Their emotions don't flag themselves out. They don't go all over the place.
Right.
And clearly he found that in his research that one of every single one of these highly successful traders had that in common on their personality profiles. And
was it the flip side with the not so successful traders?
Well, he didn't do not successful traders, but I know people that I've seen who will yell and shout and scream, I did this, I made this much money, and I go, the guy's going to lose. He will end up a loser, because you can't have that mindset in this business. So I'm so powerful, I'm so strong. No, you're not. You better respect the markets, because if you get ahead of the market, and I've done that, so I have good experience in that. It's a bad path to be on.
Yeah, I could totally see that. It's a really, really interesting study, though. I wonder if we could shift gears a little bit, and I'm aware that I need to get some technicals in and make sure that I don't drift too far off the mark. And so one thing that I've heard you talk about is death by 1,000 indicators, or just death by indicators in general. Could you talk just a little bit about what you mean by that and how you approach charts? And
yeah, sure. There's a great John Prine song. I think John Denver also sang it. And the line is something about blow up your TV, eat a lot of peaches. You got to find Jesus on your own. And it's like, get rid of all this distractions around you. And when I look at people's in the charts in the old days or now the computers, they have MACD from my buddy Jerry Appel, stochastics from Ralph Dyson, Bollinger Bands from my friend John Bollinger, my percent R, MACD. It's like they're all redundant to the same thing. They're just because you read about them in a book, first of all, it doesn't mean they're any good. You be very careful about that. You have to understand how to use them. But to me, if you look at my chart, I don't have many indicators. And each one is for a separate and specific purpose. One would measure trend. One would measure accumulation in the market. One would measure time cycles or seasonals. So each one is not redundant of another one. Whereas most people just have the conventional indicators, not realizing they're all the same thing. It doesn't help you.
There's definitely a lot of redundancy. And, as part of the STA, we teach many indicators. And the idea there is to be able to understand them and then make a call for yourself on which tools you want to put in your toolbox, right? Because it needs to work for you. But it can take a while to figure out. I mean, I've been through it, throw 1,000 indicators on your chart and then realize, wait a second, these are all showing me some of the same thing, or I just can't find price anymore. So you go through the cycle of taking them all back off again, I think, right? So I really like your approach of how you seem to categorize indicators for specific purposes. You mentioned quite a few just then. One thing that I really sort of liked about your approach is how you use different types of data as well, and that I would classify that as sort of like, into some of those categories. So if I'm going to try to trade like Larry right now, the way that I see that, and correct me if I'm wrong, please, but you focus a lot on cycles or seasonals, and maybe you consider those the same. So that's based on price, and they're not the same, it looks like. Yeah.
Correct.
So cycles are longer term than seasonals, which are primarily annual.
Seasonal is how a price is traded year in and year out over a long time period. They're a suggestion, but we may not follow the seasonal pattern this year. So that brings in one cycle saying, yeah, whatever these emotional binges that the markets take, when they seem to occur on a pretty consistent basis. When I first started trading in 1962, I had this idea that cycles were all that mattered, that all the technical analysis, all the politics, all the economic theory, all that is a bunch of, it doesn't mean anything. That there's times when the emotions are very bullish and they'll go for quite a while, and then the emotions are very bearish and they go for a while, and then I thought it was all about cycles. I got away from that because I couldn't find how to make them work. So the reality didn't fit my idea. But now I think I'm back to that point, and I think that we're able to pretty well say, yeah, this is the path the market will be on. I'll show some examples in a moment as well. So I'm not just going to say, yeah, this is what it is. I'd like to share that with you. And the other point that you touched on is I don't just look at standard technical stuff. I look at the Federal Reserve System. I look at economic data. I'm not just into technical analysis, but I will analyze Federal Reserve System on a technical basis. I do that. I commit that sin.
Understood. So from the way I see it, you've got cycles, you've got, we'll call it the F word for us, right? Fundamentals. But there's a lot of value and use in there. I've heard you talk about where the smart money is going, as in, and I think you're getting to things like looking at the COT reports, right? The commitment of trader reports, accumulation, distribution.
Like the commitment of trader reports. I've been using that since 1970. And that's changed quite a bit over the years. But I also have come up with ways of measuring accumulation in the market. Each day, there are big players in the market, and they buy and sell in a certain fashion. I think I figured that out. So I can see at the end of the day where let's call them the big boys, the powers, were they net long or net short? What were they doing? And and clearly the evidence shows that when they become excessive on the accumulation side, the market's almost always, not always, nothing's always, but almost always will rally. So, and that doesn't mean they're going to rally now. It means it's a condition. They have accumulated. The market should rally, but I still need something, technical analysis, a trend change, a breakout, whatever, above a moving average trend line. I still need something to confirm, yeah, they accumulated, and now the move begins.
And so that accumulation, are you measuring that based on, I'm assuming it's not price movement, but is that the POIV? So price, open interest, and volume. Is that part of that picture?
One of the tools I've developed and combines price, open interest, and volume all in one tool. Kind of a spin-off. My friend Joe Granville popularized unbalanced volume. Yeah. And then in the late 1960s, I did something with my accumulation distribution based on the opening price, which is a major change in technical analysis. Always use OBB before, and found another way of using it. But after studying the commitment trader report all these years, I noticed that they accumulate in a certain fashion. You study that intensely to see, yeah, these are the type of days they buy and how they get into the market. So I've tried to adapt what I learned from that. So if they were buying Amazon, how would they be doing it? And I think the same thing applies there, and when it's under accumulation, like I said, they usually rally. When distribution, the first this year, there's a lot of distribution in stock. No wonder they came down.
Right. So when you're looking at stocks, presumably is open interest part of that picture, or is it really price
Well,
control?
stocks, of course, we don't have open interest. We just have volume and price action. So I have to look at volume, which could be terribly misleading. I've once thought that volume was the answer to all this, but the problem with volume, and it's huge. You may have a lot of volume in the market because one fund is swapping a block of stock with another fund. It's not real accumulation distribution. Right now, we have year-end tax selling. That's not real accumulation distribution. So as often you'll see large volume or lack of volume in the market has nothing to do with real accumulation of buying and selling pressures. So volume is part of it, but it's one reason why unbalanced volume hasn't held up all that well. It's okay, it's a good tool, but it's not the best. Because volume is not at least in my world, is not the panacea. I spent 12 months of my life doing nothing at all but studying volume. I didn't look at anything that year but volume. And at the end of the year, I concluded I couldn't learn anything from it. Like, well, either now it may well be I'm just not smart enough to figure it out, and hopefully somebody else will, but I couldn't. After 12 months, all I did every day, every week, study volume. At the end, there wasn't anything I could bank on.
Yeah, I've actually heard others talk about that as well, how they like to use volume. In fact, one of my friend and mentor, Dr. Ken Long, was talking about that recently, how he's tried to study volume quite a lot, but he hasn't been able to make too much use of it yet, but he feels like there's something there.
Well, you'd think there's something there, and maybe it's just we're not smart enough. Could well be it. Yeah, I tested and tested and tested, and I haven't been able to find it. Hopefully somebody else will.
Well, could I ask you, Dr. Long actually had a question that he wanted me to bring up today, and it was really about, he's interested in how you think about indicators. And specifically, it's more about when do you invent something of your own versus maybe adapt something that you've seen from somebody else?
Well, first of all, I think you have to be careful. All indicators, especially mine or anybody's actually. And it's such a different world. We have to go back in time. When I started trading in the 1960s, there were 2 or 3 indicators. That was it. So people say, "Oh, Larry is so creative. He created all these, a bright guy, made all these." I had to. There wasn't any other choice. So I wasn't so smart or anything. It was just like we didn't have any indicators back then. And now all these indicators are an aberration of somebody else's indicator. Yes. So really to understand these, you have to go way back in time. And they were created for a purpose back then. And another part of that, which you probably remember, one thing I talk a lot about, the big averages are 10-day average, 20-day average, 50-day average, 200-day average. Well, why? Because we didn't have adding machines or calculators in the 1960s. Right. So you had a little machine, you punch and pull down a handle, it would just only do addition. That's all that it did. No division, no multiplication. So you get a column that average last 10 prices and move the decimal point over just 1 point. And then double that for a 20-day or 5 for a 50-day. And that's why those averages were used, because mathematically we didn't have the tools we have today. So they may not have been the best time frames. We don't know that. Right. They became popular because they were easy or simple to execute, right? Because of course, back then you're spending a lot of time doing these updates daily or however. I hired people that did nothing but come in after the close every day and ran numbers. Right. And they made errors sometimes. They were like computers. Yeah. Right. But the indicators, again, I think you just think about it, they serve a purpose. And when I started thinking about indicators, because there maybe when I started, there were maybe 5 or 6 indicators. Well, why is it here? My dad was, an uneducated man, was a very, very brilliant man. And he always said, Larry, you have to have the right tool for the right job. And I thought, well, I have the job of trading here. What tool? Well, it's all the same tool. And really it was my father's inspiration to think about what tools do I need for this? Oh, I need a trend change, a trend. Yeah, I need specific tools. And that's really where that idea came from.
Very interesting. So maybe we could talk about percent R for a minute. Williams percent R. It's one of your probably better known indicators. I'm a heavy user of it myself.
I'm not either.
No, I am.
I actually use it in a very different way.
Oh.
I still do use it actually. It's on every chart, but in a very different way. So, you know, something I did when I was a kid in the 1960s, and it got picked up in a book, and you know, because I was at the beginning of all this, the indicator's still there. It's an overbought, oversold indicator. It looks exactly like Bollinger percent B. It looks exactly like stochastic. They all look, they're all the same. It's the way to use it, or any of these indicators really, is in a downtrend, you want to sell when it's overbought, and in an uptrend, you want to buy when it's oversold. That's really all you have to do for any of these oscillators, mine or anybody else's.
Yeah. I totally agree. But there's still quite a lot of information in there. I like the indicator because in a way of its in its simplicity. And you know, it's like you said, very similar to stochastics. So if for you, what do you use on the trend side of that equation? So if you're going to use maybe overbought, oversold as a way of entering on the next maybe pullback in that trend, what do you use to define that trend itself?
I look at the chart.
Okay.
That's it.
Yeah, don't need an indicator.
If you didn't want to do that, you wanted to be more mathematically inclined, I'd use a 50-day average of prices.
Yeah.
And if that's an uptrend, I'm in an uptrend. If prices above it, I'm in an uptrend. Price may be below it a little bit, or it's still an uptrend. I think I'm in an uptrend. That's probably the simplest way, and it's very effective. I've been using that since the 1960s.
Yeah,
there are more complex ways, but you know, I really like Occam's razor. I want to keep things really simple.
Yeah, I totally agree. One other thing on Williams percent R, if I could for a minute. I mentioned Dr. Ken Long a minute ago, and so he's introduced me to a few different ways of using it, not using it on its own, but layering it with other things, other tools, a bit like what you're talking about with identifying trend, and then using it as a component to maybe a trading strategy. Now he came up with a slightly different, just a little tweak to it. So I think that may be part of the root of his question. And so again, it's a simple one, but you know, Williams percent R, and just in case people aren't familiar with it, you basically got a window, and let's just call it 10 bars back. You've got a window of 10 bars or 10 days, find the high and the low, and then you compare the close to the high. Where are we within that range of the last 10 days? And it gives you an idea of where we've been. So Dr. Ken Long's tweak to it, I think he calls it the NDX, and he basically just shifts the window back a bar. And I don't know if this is exclusive to him, maybe somebody else has come up with this as well. But by moving the window that you compare it to back a bar, now you're expanding the bounds of where the indicator can go, because it's bounded right between, I think the original calc was minus 100 to 0, right? On the low side, minus 100 to 0. But if you move the window back a bar, now you can see how did today's close compare to the last, say, 10 bars. And so if it's say, in this case, it would be over 0. Now it gives you an idea of how much of a breakout of that range was it. And then if we're inside of that window still, well, then we're still ranging, or we're still inside that last 10 bar window. And so it can give you an extra little push for like, how big of a break was this, as opposed to indicator values sort of clustering around, say, between 0 and minus 9. I usually do it the other way around, but between, say, 0 and minus 10, right? You'll get a lot of values as prices may be trending, or it's closing at extremes that'll be, you know, at minus 10 or higher, or just all the way up to squeezing into the extremes. But sometimes it's nice to see, like, are we really breaking out of a range? So that could be a useful tool.
The problem, that's a mathematical problem with all indicators. They get locked into a time frame. If you have 14 days, you're locked into that. So we found a way to get outside of that. I would add, and I think this, I should do a book about this or something. This is really the most important thing about all these oscillators, all the price-based tools. I think that if you use them as a study of momentum, there are patterns of momentum the repeat in these oscillators, whether it's MACD or whatever it is, there are patterns in the momentum that are really predictable and really powerful. We just had one at the bottom in the S&Ps. We had one in crude oil before it took off, one in gold. There's a pattern. Momentum does a certain thing, and then the markets move. And so I would, in my mind, I've thrown away a lot of looking at just price patterns and candlesticks and all that. I want to find these repetitive patterns of momentum, because the price is actually like this, but we smooth it with mathematics to get the momentum of the market. And that's, to me, is I wish I had more time to spend on that and was smarter than I am, but somebody should pick up on that. The patterns of momentum, really powerful and predictable.
Do you mean, or could those patterns be things like divergences, or are you not a fan of that strategy?
Divergences work until they don't.
Yeah, there's a lot of false positives with divergences.
Yeah. So it's a basic step. Sure, we were doing that in the 1960s, 1963, 64. We're
Right.
creating a bull market, and the 66 bear market, and all the divergences were wrong. So,
right.
but the idea that is right. There's a pattern to, if people would stop looking at head and shoulders in charts and look for, let's say, head and shoulders in the oscillator or another pattern, I think they'd find it more fruition in that.
Yeah, very interesting. I wonder if we could, well, if we just stick with that topic for just a second. So from a technicals point of view, because I'm kind of aware that in my mind, we're building up a bit of a picture of almost layering up different elements that we're stacking together to form a case or a story for where we are today. So, we may have cycles and then fundamentals on our side. And then maybe you're seeing something where the smart money is starting to come into a market. And then I don't know if you're looking at specific price patterns, but then you're probably going to see something happening with momentum, where you've got that sort of serial correlation coming into the market where, there's just the herd has decided to start moving in a certain direction, and that becomes evident. And then you've kind of got the overbought and oversold indicators can sort of show you the extremes of that. And then ultimately that results in a trending move. And then maybe the OBOS moves are those smaller waves in a trend. Is that sort of how you look at it?
Pretty complex, doesn't it?
Okay, yeah, too much.
The way I do it doesn't mean that it's right by any stretch of the imagination.
Yeah.
I want to get a sense of where the market's going to go. I can do that with cycles and seasonals. I can do that primarily in the future trader with commitment trader report. Those three things give me a pretty good idea of the bias to the market. Once I have established a bias, like right now, the stock market is a very, very, very bullish bias. Okay, so I want to take short-term buy signal or intermediate term, any buy signal, full moon, astrology, throw a dart, whatever you want to use, because I have a pretty good, and I could be wrong in my analysis of the trend, but I have a pretty good idea. So I first want to establish what the roadmap, where I'm in. So I'll show the charts in a moment, we'll show you exactly the roadmap I see coming up. So once I have that, then I know what to do, because clearly a buy signal in a bear market is not as good as a buy signal in a bull market. So what's the condition I'm in here? I want to know the condition that I'm in. Then I can bring in whatever technical stuff you want. It doesn't matter. But the most important thing, as I see it, is what condition am I in here? Is the bias to the long side, or is there a bearish bias? Then I can work the bias.
Gotcha. Yeah. So essentially you're defining the condition first, and then you're using a suite of tools to be able to get involved in that condition.
Anything really.
Yeah.
Again, I use technical stuff, but so much of technical stuff is a bunch of, in my opinion, a bunch of mumbo jumbo that nobody understands it. Some of it I think is real. It's so confusing to me. So I just try to make it really as simple as I can.
Yeah, I think simple is best. So I wonder if we could talk a little bit about the trading championships. because I'm assuming that, yeah, I'm sure you get asked this all the time. So I'm going to try to approach it from a slightly different take. I'm actually more interested in maybe as an extension of the discussion we were just having about those conditions. So, for those that don't know, Larry won a trading championship back in 1987 and probably others since, but in quite spectacular fashion. And I'm wondering did the conditions align in that particular year? Was everything favorable? Were you in line with the market, or do you attribute that to anything in particular?
Yes, I attribute to a couple of things. I think the conditions are actually more favorable in the market this year than they were when I won the trading championship. But people gloss over the trading championship. I started with $10,000 and ran it up to a little over $2 million by October. And then I went to Africa on a safari, and we had the crash in 1987. And the $2 million account went down to $750,000.
Wow.
So that's a big swing.
Yeah.
I came back from the safari and traded it back from the $720,000 thing to 1.1 million or whatever it was, something over $1 million. And that was the end of it. So there was a huge swing there. So
yeah.
Why I have those spectacular results, there's three driving forces. One, I was pretty right on the market, okay? But why was I? Because I was totally focused on the market. And clearly I wasn't a nice person to be around at that year, because that's all I cared about. I didn't care about my kids. I didn't care about anything. I was just about focus on, I wanted to win this championship.
Mm-hmm.
And then I used a very, very, very aggressive form of money management. I was crazy. I didn't know what I was doing. But the form of money management was wildly aggressive. And so those are the three things: a very aggressive money management, totally focused on the markets. And, I had some skills that I was able to use.
So I was curious about the mindset going into that year when you decide that you're going to take part in this championship, and I'm sure you're probably doing other things at the same time. But was the goal? I already know the answer. Was the goal to win the championship, or was the goal to grow the account in the best way that you could, or was it just like a total focus on yeah, I'm gonna come out of it as the top dog this year?
Well, I think it varied. When I first got in the trading championship, yeah, I liked to win. I won a couple before that. But well, let's see what I can do this year. And so that was part of it. I'm a competitive person. I think you have to be a competitive person to be good at this to begin with.
Yeah.
And then as it started to get really some pretty good results, that's where I got very aggressive and very focused on. But running through all that was, hey, let's have a good time. Let's see what we can do here. So there were 3 or 4 screens going through there. One, yeah, I want to win, I'm competitive. 2, let's see what we can do. It's really, I mean, I remember people criticizing me in the contest because I was only trading bonds in the S&P. So if you look at the records, you'll see I suddenly start trading pork belly and soybeans. I don't know how many trades I had, 10 trades, whatever. Just say, hey, look, I'm good. I can do other markets too. And I would never do that now. I hope the markets have made me much more humble. So maybe that was one of the other things. I wasn't humble at all. I was an idiot. I was a jerk. And but sometimes that can drive you to do those things. The important thing about the trading championships is not that I won it with whatever the results were, but that almost every year the winners are students of mine. And that isn't not a braggadocio thing for me, but it shows that people can learn to do this, that we've been able to transfer this knowledge from myself and a little experience I have to other people. And these people twist it and make it much better, and they go on to win the championship, sometimes repeatedly. And that's been, to me, the most exciting thing to see people I've worked with win on a consistent basis. And because they learn money management, they learn technical analysis, they learn a trade. So this is the good news, is that this stuff is teachable. These people from all walks of life that have won these trading championships. Andre Unger in Italy, I mean, he won 3, 4, 5 times, something like that. But they all take a little bit from Larry and then add their own twist to it, think about it a little bit. I open some doors for people, that's what I do. But clearly that door opens up to a room where there's trading success.
Right. Are there any tips you can share with us? I mean, what do you tell the guys who I don't know, come to you and want to take part?
I mean, the basic rules, money management. You got to be able to, if you're going to win a trading championship, you have to be aggressive in your money management. So that's
Right.
one thing. And then if you trade just one trade for the year, you're not going to win the trading championship. You have to have a lot of trades. Why do they have Las Vegas open 24 hours a day? Because they got to spin the wheel, spin 60 times an hour or whatever, right? So to really accentuate your account, you have to have a turnover. You've got to try to maximize your return. So you're trading. I didn't do any intraday trading, or me. If I did, I was stopped out every day. But you're looking at 2, 3, 4, 12-day time frame, something like that.
Okay, that was my next question, actually. Yeah. So the sort of ideal time frame is more of a swing sort of time frame, maybe with an intraday element for entries.
Yeah, sure.
Okay.
I know, I don't know what's happened to the bond market today. I placed my bond order last night to buy at a specific price in the market, and I don't need to watch the market. I'll find out when it closes, and I get filled or not. I don't have any idea.
Right. Well, one of the things I found most impressive in a way is that your daughter won as well, which would have been through your guidance, surely. And I guess for those that don't know, your daughter is Michelle Williams, who is quite a well-known actress. And for me, that's Dawson's Creek and Inception. And I was thinking about the timeline, because I think it was 97 that she won it. And that's right around Dawson's Creek time. And I'm thinking, how is she pulling off winning a trading championship and doing this in about the same sort of time frame? Am I on or off on that?
No, you're right on. It's a very interesting story. Michelle didn't go to school. I homeschooled Michelle.
Mhm.
So part of homeschool was to learn how to trade, right? And it was homeschooling. Like a friend of mine said, look, if you're going to homeschool somebody, she wants to be an actress. So she doesn't need to learn physics. She needs to learn percentages, because the agents are going to charge a percentage. She doesn't need anything other than percentages. She needs to know the history of the theater, and then she'll love history. She needs to know about health, so you can stay healthy, so you can be on shows. So if you adapt that education to their areas of interest, then the students get really interested in it. So it was an interesting process, and she started trading. I told her, this is the buy, this is the sell. And after a while, because of Dawson's Creek, sometimes the call would be 4 or 5 in the morning, and we'd have to go on down to the studio. So finally, I said, look, we've got an automatic system. Why don't you just trade that? So she did, because she was in the contest. She called up Gene, the broker at Robbins, and said, take one trade, one contract for every $10,000 in the account. She started with $10,000 and ran it up to $110,000. Just following the system. Now, the really interesting thing here is not that she won it, but at the same time, another person was following the system, and he came to see me in Wilmington, North Carolina, and said, this damn system, I'm not doing very well with the system. I said, really? What's going on, Roger? He said, well, that last trade in bonds, I lost a lot of money. So what happened? He said, well, I had on 15 contracts. I said, oh, what about that big winning trade we had last week? Oh, I only had on 2 contracts. So, so here, exact same system. One person makes a lot of money with it. One person doesn't, not because of the system, not because of their emotions, but because of the commitment that they made was not consistent.
Right.
They try to pick and choose. So with the consistency of increasing your performance in your positions in these accounts based on your performance. And you can't do hit and miss. I like this, I don't like that. So that was really the big lesson from that year.
So yeah, position sizing, really, right? So having that consistent sort of size per trade, and then scaling that up. And so for either for the championships or for your own trading now, if it's different? How do you approach that today? Is it a similar thing where it's one contract per a certain number of money, like 10,000 is quite common?
Yeah, it's similar to that. By the way, I should point out that Michelle's sister Paige also won a trading championship a couple of years ago. This stuff is teachable. But yeah, for my account, I know if I have $1 million in the account that I'm trading, then I don't want to risk any more than an X percent. Right. Generally speaking, 3-4% is plenty of risk in a trade. So I might have on 4 trades at a time, 4 different markets. I wouldn't take 4 positions like corn, wheat, soybean meal, and soybeans. It's all the same trade, really. Right. So if I'm going to have 4 positions, it will be maybe a grain, a meat, a stock index, and a currency. So you have to be careful that you're not bunching into just one family. But yeah, I'm 2% is probably what most people use. Even at 80 years of age, I'm a little more aggressive than that, I hope. So my bet size is a little bit larger than that.
Yeah, I'm guessing that first year that year when you won the championship, that you weren't following that sort of position sizing.
30% on every trade. We risked 30% of the account on every trade. Okay.
So you want with your first 1 or 2 to be profitable. And
you gotta be. Yeah.
Oh, excellent. So for your own trading these days, how would you say your mindset has changed, or maybe your style from those days of maybe championships, which is a different sort of game that you're trying to win?
Well, I think that I'm not as stressed now. I don't have to make millions of dollars every year trading. I don't have to prove anything to anybody in the world. I've been around doing this 60 years now. Next year will be my 61st year trading. I don't have to prove anything anymore. Okay, I've been around. If you don't like me, fine. Tell me I'm ugly, whatever. I don't have that that I have to prove Larry to anybody anymore. That's a huge difference. That was totally in my mind, but it was big there. It really was. I don't have that anymore. My trades are probably for a little longer term basis. I don't want the pressures. That I, doing this for 60 years, almost every day was a intense pressure, being a pressure cooker. And I've been in that pressure cooker right now. So I'm not quite I don't have as many trades right now. I have one trade, long stocks. So that, I get old, I get slow, I slur my words, I probably drool when I eat. And after I get old, some things start to change.
No, I think that makes a lot of sense. I mean, it's and if I'm reading into it right, so do you only look at, say, maybe daily bars these days? Do you dip into intraday at all? For analysis or
on the weekend, I look at weekly bars for my setups. Then during the week, I'll look at daily bars. I have one really good indicator for intraday stock prices. Well, actually for any intraday, most not all, but most any commodity, a cycle forecast tool that I use. It's really good. So I'll look at that, but I don't trade on it. A lot of people do, but do I need another trade? I've had, I don't know, 10 million trades in my life. So I just need a big winner. So there was a nice buy point today. Like, oh, I should be a buyer. Then, oh, come on, Larry, you got a nice position on. So the anxiety level has gone way down as I've gotten older. And I think I understand the markets a little bit better now, not much, but a little bit. And because of that, I'm not as anxious. I feel more comfortable trading than I've ever felt in my life.
Wow, that's a big statement, actually. I like that. One other thing I've heard you talk about before, you mentioned 10 million trades that you've probably done yourself. 30 million trades, which was, I think, a sample that you did a bit of analysis on before. And so I saw this somewhere and I wanted to ask you about it if it came up, because number one, I'm curious as to where the sample came from and if it's available for others to grab. It must have come from brokerages or something, I would have thought.
I know the study, yes. It was a study done by a brokerage firm, I forget. I stumbled across this thing maybe 6-7 years ago, but it showed, again, not exact number, but 30, 40 million trades, whatever. On balance, their traders, these were strictly future traders, their traders were won on more than 50% of the trades. I think they were like 53, 54% accurate. So they won most of their trades and they lost money. So it isn't just about accuracy, it's about the risk reward. How much do you win and how much do you lose? What's happening,
Right.
they were winning on more than half their trades, but when they lost, they got tagged really big. So it's money management. That you can't let your losses get a lot bigger than your gains, because
Right.
you can have 90% winning trades and still lose money trading. You have one big loss and 9 winners and one big loss, you're toast. So the other interesting, another study, and this one was done at Fidelity, they looked at all their stock trading accounts and to see who've been most successful. And they found that the very most successful people, the ones that made the most in their accounts, were people that forgot they had an account.
That's a bit depressing, isn't it? But yeah, that makes a lot of sense.
Oh, yeah, those stock. And there's two interesting points I'd like to make here. I don't know if I have a chart to show on that. I may or may not, I forget. And I just bought the Dow Jones Industrial Average in 1962 for $10,000 when I started. I didn't have $10,000 yet, but let's use that number. I would now have $3.6 million and done nothing. So the long-term trend of the market, and this would drive me crazy about the bearish people. For half my life, I was bearish. I always wanted to sell the market. I made my first $1 million selling short, so I wanted to, I like that, right? But the trend of the market is up. And if you're going to be bearish, you better be really selective when you're bearish, because it doesn't go down very much. If you're in the averages, if you're going to have a bias alongside, Vic Niederhofer taught me that lesson, drove it into my mind. I'm so indebted to Vic for really pounding that through my thick Norwegian skull, because it took a lot, and Vic was really helpful for that.
Wow, excellent. Maybe we should look at a couple charts. I know that you
great, let's
brought
do that.
a couple with us.
Let's
So
see
yeah,
if I
it
can
seems like
do
a good
that.
time.
Let's see now. I'm going to share a screen. Do you see the screen now?
I do. Yep, it's just come up.
The fireside chat. Okay, great. Well,
That's
let's
it.
go. Well, this is on September 9th. I did a YouTube video. You can still see it said down, then up, up, and away. So it kind of gives you a background of where we were at the 1st of September, what my thinking was, and we did go down. And then in October, I did from down to up, up, and away. And that's where I think we are now. Oh, here's the chart I was talking about. This is the last 50 years of the Dow Jones Industrial Average. These are yearly bars, but you don't see a lot of red ones, do you?
No.
You see a lot of green ones. Oh, here we had 2 years down. Let's see, a couple of years down there, and that's about it. So, you know, the crash of 2008, well, actually 1 year down. So again, if you're going to have a bias, it should be the long side. There's all the Cassandras. Again, my psychiatrist son said, Dad, people have an inborn bred to be negative about things. We have a cognitive bearish bias. We love bad news. And I had my degree in journalism. First thing I learned in journalism school, if it bleeds, it leads.
Right.
You don't write stories about the houses that didn't burn down. Last night in my town, 100,000 houses didn't burn down, but one did. Oh, it's a big story.
Right.
So people like bad news, so stay away from bad news. This is the forecast we did last year. You know, so this is the start of 2022. This is my annual forecast report. This is the only thing I publish anymore. And you can see what the forecast was about the end of the year, which will start to rally again. So again, as we mentioned earlier, get an idea, general idea of the roadmap for stocks. So I do look at fundamentals. This one's something I've been doing interesting that intrigues me. The green line is money supply and the black line is gross domestic product. And you notice they actually parallel each other quite a lot. They peak and drop at the same time. However, the green line, money supply, has been pushed forward almost 2 years. So, and this is where we are right now with GDP. It looks like GDP is going to start to come up, as it has typically followed this money supply lead time. So I think that's somewhat bullish. Not the only reason I want to be bullish, but kind of interesting that we can use technical analysis to look at fundamental things. And I do a lot of that. And it's helpful because it gives you more confidence in your position. The big thing, of course, this year has been inflation. So here's the Federal Reserve sticky inflation, and this is like it's going straight up. We're going to have a big inflation report this week. It's going to be bullish, bearish, I don't know. But there are other ways of looking at inflation. The Federal Reserve Bank of Cleveland, if we look at their inflation numbers, look at that, they've actually started to come down a little bit. So it's not quite as bad as the Federal Reserve of St. Louis. And if we look at the New York Fed, they have a UIG inflation index, and you can Google that yourself. It's already peaked. In fact, I've got a blow up. You can see it right here. So I think that we've got a cyclical high in inflation, and that this inflation bugaboo we've probably been having is about over. If I'm right on that, it means that soon the Fed will either increase interest rates at a smaller rate than they have, or maybe none at all. But inflation has been the driving emotional force in the market this year. My view is that we're in the area of a top in inflation.
Gotcha.
So the gray lines, as everybody probably knows, are recessions. Are we in a recession? Because one thing I really believe is if you're in a recession, stocks really get clobbered. So you got to be careful of recessions. That's one of the best bear market predictors that I found. Well, currently, if we're looking at unemployment claims, we haven't seen them pick up in here. When they have picked up, we've gone into recessions, but that hasn't happened this time. So that's the reason I think to be bullish. We look at inflation or unemployment here and we see the same thing. It hasn't picked up like it did back in 2008. Unemployment starts to go up, you're going to get into a recession, and that hasn't happened. So I still think we have a very mixed part of the economy. Is very bad right now with inflation, getting deliveries of things, but the other part is really strong. People have jobs. So that's one reason to be, I think, longer term bullish. Well, I know everybody wants to know where we gotta go. So here's a couple of prices. This is gold. This was done actually middle of October. And that's my forecast for gold. So as somebody trading gold, I'm looking to buy pullbacks or short-term breakouts. I think that's the path that gold will follow. That's what I think is the projection. It's done pretty well. I don't expect it to call every twist and turn, but to give me a bias.
This is based on a cycles analysis, is it, Larry?
This is based on a combination of cycles, yeah.
Okay.
Crude oil right now, again, this was made 1st of October. And you see the suggestion that we should rally, but then we should start to come down about the end of the year. And that's the way I would want to trade this market on the long side, but limited till the end of the year. So then you can bring in whatever technical stuff you have. I don't care if Fibonacci, Gann, Elliott astrology, as long as you have a good idea of a bias in the market. That's what I think most people are lacking.
So if we go back to gold for, I'm sorry, to oil for just a second, so you've got essentially what you're saying is that maybe long biased up to the end of the year, but then look out.
Yeah. Now then here's the other problem with cycles. Cycles go from here to here to here to here. Right. They predict a buy over here, a buy here, a buy here. They don't tell us how big this buy will be. They don't predict magnitude. So people say, oh, a big decline here. No, it's just that we're going to go down from here to here. But the magnitude cycles do not predict. You can't use cycles to predict magnitude. This could be a great big rally or just be a little rally like this. They don't predict magnitude. Magnitude is going to come from the technical tools and in futures from the Community Trader Report.
Right.
Okay, FANG stocks have been just really beat up this year, and I think we're going to see them rallying here, but around the end of the year. Oh, excuse me, that was not supposed to happen.
It's all right.
Oh, sorry about that.
No problem.
So I think at the end of the year, we should start to see this whole group of FANG stocks take off to the upside. They'll rally now, they'll pull back in December, but around the end of December, I think we're going to see those particular stocks start to rally. It's about time. We've been in a big long downtrend here.
They've been pretty beat up for sure. Are we looking at is this again a cycles based forecast?
How can I describe it? A combination of cycles and seasonals.
Okay.
Together, and this is the FANG. This is an ETF of the FANG. It isn't just any one of the stocks.
Yeah.
Amazon. Amazon should start to rally here, but the sweet spot for Amazon comes in March. I can measure how often in the past we've seen this cyclical phase with rally. It's been 100% of the time. So come March, I think we're going to see, and it isn't every March, like last March, we didn't have this rally, but in this longer term cycle where we are now, come next March, I think we're going to have a nice rally in Amazon's. We should start to rally in Amazon now, have a little decline, but then this is that's a tradable, almost what I'd say bankable cyclical time period to be in Amazon. So you can see we can go way out in the future. You can't always find these really high profitable trades. Sometimes they're there, sometimes they're not. Bitcoin has gone bust, in my word. And I think that is a great lesson from the Zurich axioms. Don't invest in fads. You could trade this thing as a fad, but you don't invest. Bitcoin to me has always been a fad. And it's a living proof of the Zurich axioms. Don't invest in fads. This is toast. It's forever before this comes back. Why? Because all this overhead supply, whenever Bitcoin rallies, all these people are going to try to sell to get out.
That's right.
Don't invest in fads.
Interesting. Okay.
This is my 2022 forecast, again done last year for crude oil, of what should happen in crude oil. And this is that buy point that we just saw. So you got a pretty good idea, and this is a longer term blue line of it, of we don't know how big the decline will be, but that's about when we peak out.
Right.
It's about what's going to peak out at the end of the year. But again, cycles talk about buy here, one coming up over here, sells here, but they don't tell us how steep it will be. You got to keep that in mind if you're going to use cycles. Big lesson, don't go, oh, that looks really bullish. No, it just says should rally from here to here.
Right. It could be misleading. You're looking at the chart. It looks like a large move, but it's really just to give you an indication of bias.
Don't let your eyes deceive you. It just says, and cycle people they miss that. They think cycles are the be all end all. They're not. There is no be all end all in this business. Not that I've ever found. It says, yeah, there's a buying opportunity and there's a take profit selling opportunity, but how big it will be, that's why in technical analysis we have trend following mechanism. Maybe my will stop or parabolic or whatever trend indicator. Yeah, just let your trend indicator ride the trend. That's it.
Very good.
Tesla, I think, had some troubles ahead. I'm sorry, you got a question, Jeff?
Oh, I was just going to let you know, in case you don't, that we're sort of looking at your chest. Maybe you may have moved your camera or lid to a laptop or something.
Oh, like that. Okay.
There you go.
That was on both. Okay.
Thank you. That's better.
Better view, like in my belly and stuff. So Tesla, it looks like we've got some problems coming up in Tesla. Rally phrase in here, but then that's it. I'm going to close that so I can see the chart. So around the end of December, the middle of December, I'd be looking for Tesla to move back to the downside. Hope for the DAX for all you guys over there in Europe. Now we have an 80% probability of rallying from right now into late February. We had a 70% down move from here to here, pretty much what happened. And now we have a really strong seasonal cyclical bias to the upside in the DAX index.
Good to hear.
And finally, the Dow's ready to rock and roll.
Okay.
We have an 80% probability of up from December into February. You can see the general roadmap for this market. After I can take this out, for a year. I'm working on my annual forecast now, which we'll have ready in the end of December. But I think we're going to see more strength in here. Maybe a sideways move. It doesn't matter. This has never been a big down move, but starting, you got the picture. I mean, it's pretty clear. And this is interesting to me because if you go on the internet, so many bearish people. We're going to end in 7 days or 2 days or 3 hours or whatever. I just don't think that's true. Based on cycles, and I mean, I'm way out on a limb here. Legendary Larry is going to be dead wrong here. He's really right. But, if you can't go to the end of the limb, you're not very confident. So I'm confident to go out there. And I would say unequivocally, I think we're starting a couple of year bull market, at least a year in here. And this is the first phase up. We've seen it, maybe a little bit of a pullback going higher.
So
that's all I have. So I'll let you take it from there. But
all right.
That's all I have.
That's great. No, thank you. Thank you for running through that. I guess my first question would be, is there somewhere where people can figure out or can find more about how you do your cycle and seasonal analysis that you were showing us?
Not really. I don't still know how to do it. I haven't yet codified it. I do my annual forecast report. People go to ireallytrade.com and sign up there.
Okay.
But I'm still, maybe I'll publish it at some point, but it's still a labor of love. And I learned a lot this year. So it's, I can't say, here's the rules, guys and gals. I'm not good enough to do that yet. I wish I was, but I haven't cracked all of the code for sure.
No worries. No, that sounds good. With regards to maybe positions that you're holding or thinking about putting on currently, I think you mentioned that you're long equities, and I don't know if that's via the YM like Dow or S&P, or do you have a favorite?
Well, I usually trade the S&P 500.
Yeah.
And my wife has been buying stocks recently. Microsoft. What else you buy? You buy Amazon, maybe Google.
Okay.
Costco. The stock I really like, nobody followed it. JKHY, John Henry and Associates. No, put that one on your list. JKHY. Like, there's a stock that can't go down.
Okay. Well, now you mentioned bonds earlier, and that you've got an order in the market. I'm presuming that's to get long bonds. Now they've been pretty crushed recently, right? So could you talk us through your thinking on the bond side?
Well, a couple of things. Years ago, my good friend Tom DeMark and I created a system called Sequential, which Tom has really popularized and had a great career with it.
Yeah.
Sequential is close to a buy signal in here. So that's one thing. The commercials have been long. The public speculators are very negative on the market. I've seen some accumulation come in here, and that pattern and momentum that I like is starting to develop. Plus, the cycles are suggesting the seasonal low for bonds is just a few days away. And so I think we're getting close to a zone where I can look to be a buyer.
All right, fantastic. I'm aware of the time. A few questions have come in that I haven't been able to address yet. Could you spend 5 more minutes with us?
Sure, of course.
Excellent. Okay, so I think this one is relevant to a bit to what we talked about before. With regards to position sizing. And so the question is really about how you determine the max amount you can lose per trade if you've got, say, a stop loss that's very close. So I'm presuming you're putting stop losses in immediately with buys, but that may not always be the case. But I think the question is with regards to that.
Yeah, first of all, I always have stop losses in place. That's one thing. Secondly, my stops are not very close to the market because I'm not good enough to buy right at the low tick of the market. I don't know how to do that. I don't know if anybody really does. So my stops, I know, like my bond trade, if I go long bond, my stop was like $1,200 a contract away from my entry point. For 2 reasons. First of all, I can determine that in advance because that to me is an important point in the market. And obviously, if it goes down, I'm wrong, so I got to get out of the market. But if I know that if that's my maximum exposure in the market, that can tell me how many contracts I'm going to buy. If let's say I have $100,000 account and my risk factor is $1,000, and I don't want to risk more than 4% of my account, $4,000. I could have 4 bonds on that long position. And again, my stops are not closed, because the closer your stops are, the more you'll be stopped out. People think that they are out to get them. There's no they in this business. They're not out to get you. If you're getting stopped out all the time, it's because your stops are too darn close. You pull them back, you won't get stopped out as much. People, I did when I first started trading. Who are they? I don't know who they are. And I've been around the markets for a long time. And I know the big guys in the market. They call me. They pay me for my advice. These are the billionaire traders. And they're looking for they too. There's no they there. They're not getting your stops. You're getting stopped out because your stops are too close. That's all.
So it sounds like you're basing your stop on a point on, say, a chart that you can see and determine is wrong, as opposed to maybe like a measure of volatility or something.
Yeah, I use something called market structure, which was really written a lot about by Henry Willard Chase with the supply-demands 3D formula. I learned from that, and I added a little bit to it myself. But there are points in the market you can figure out yourself. You got to say I'm wrong. The bear's got to be blown away here, because we're going to take out the recent pullback we had in the S&P or the Dow. We're breaking back above it. That's like a Dow signal, buy signal. So there are those points in the market. You got to, well, the trend is up, or in my case, if I'm wrong on my bonds, the trend is back down. I got to get out of this thing. I have to admit defeat.
Understood. There's a question from Remy about one of your books, actually. It's about the definitive guide to futures trading. And they're asking, do you still use the 1.28 and 1.618 forecasting techniques to identify potential turning points?
I don't, no. Not because there's anything wrong with them.
Yeah.
Because that book was written 30 years ago. I've come up with a couple things that are a little bit better, but the 1.28 is still a pretty good way of identifying where the next short-term high or low will be. Nothing wrong with it at all. It's just that I've got a couple better things now than I did back then. I should write another book, I suppose. We'll see.
All right. So we've got a question from Michael, who's asking if do you think a good technical indicator should be usable in all kinds of markets or assets, or that there may be some that work really well in some markets or assets, but maybe very poor in others?
Oh, that's what came first, the chicken or the egg question in a way. Now, yeah. Do I think that? Sure, we'd like to think that an indicator would work equally well in all markets. I think what I touched on earlier, the patterns of momentum do work on equally in all markets, by the way. But hogs have a different cycle to them, a different time frame to them than cattle, because the life of the animal is shorter. So you have to look at in stocks, we have quarterly earnings that come out every 3 months. So how does that affect that market? You don't have that same impact in, say, wheat prices. So you have to think a little bit about, well, what are the driving forces of this market to create your indicator? Then you can get a specific one that's going to work better there. It may not work in another market. Bonds typically start to come down on Wednesday and Thursday, usually. Not always, but usually. So that's a bias that we identified that for 25, 30 years ago. It's still there. So you need to understand your market to develop, as my dad says, right tool for the right job, right? So I prefer to do it that way than think that there's some one be-all, end-all indicator. Might be, but I think these markets are different. Certainly, Amazon trades differently than, say, Annaly Mortgage. So yeah, I like to try to get the right tool.
So related to markets in a way, do you have a favorite, say, asset class, futures, FX, options? And then Adam, who's asked that question, is also asking, sort of as a secondary, how do you pick yourself up after a big loss? So 2 questions in one there.
Yeah, first of all, I'm going to get back to slides. There's something I'd like to share with Adam. Let me share my screen. Adam, can you see that screen now?
I think, yes, I think you're still sharing. I can see it for sure.
Nothing will make you work harder at this than having a loss. So I don't enjoy losses at all, but they're really beneficial because they teach you, if you'll accept that they're a learning experience, then the losses can be really helpful. So I look at all my losses, I can learn from this. They hurt. I mean, I've had losses, $1 million losses. I have a lot of money. That was a long time ago. When I was younger, I'd make a lot, lose a lot. I didn't care. It was like a rodeo. I think Paul Tudor Jones called me kamikaze cowboy or something like that. It was a lot of fun. I didn't care. But eventually you start to care, and we didn't have any money management rules when I started this. Nobody knew what money management was, and nobody written even a book about it. But now we know. So the thing about money management gets back to that pain of the loss. Money management, truthfully, is emotional management.
Yeah.
If you can't sleep at night, it's because your bet is too big for your emotions. Your contract size is too big for your emotions. So if you want to really get your emotions controllable for you, just don't bet as much as you've been betting. Don't make as much of a commitment to the market. Then you don't get as emotional about it.
Very good. And the follow-up there from Adam was about a favorite market. And I've got a feeling you're going to say futures.
Well, yeah, I've traded futures, most of my life. So, but if I had one future to trade, it would probably be gold. Because it's so responsive to the Commander Trader Report, bonds and the stock indexes, those you can get in all the trouble you want. At least I can. I can get all the trouble I want in those three markets. I don't have to go looking any other place for trouble. It's all there.
Excellent. Just one last question about holding time frames, because I've seen some of your work about the holding to the close, and then also that some of the best moves are made overnight. So almost 2 contradicting ideas there. One of them, holding to the close, which I think you mean you get those days, like those big intraday days where it will finish near a high or a low of the day. And so there's one side is holding to the close, and that markets can top and bottom on those sort of days. And then the other side of that is holding overnight, which is where the money, I think, is going to be made in the sitting a lot of the time. And so hence you need to be aware of the time frame that you're going to trade, and be comfortable holding, like you were just saying a minute ago, that the size that you've got on. So my question really is, for you, what is your favorite sort of holding time frame, or when you've got these trades in mind after you've done all the analysis with regards to cycles and fundamentals, and are you in these positions these days for weeks to months, or are you sort of in these for a few days to, say, maybe 7-10 days?
My average trade is probably 12 days. Some are a little longer now in the stock indexes. I want to hold on for a long time now, right?
Right.
My bullishness. But
right.
To answer all that, I think this is the most important thing I can tell viewers is that we've always said the trend is your friend. If there's no trend, you're not going to make any money. It doesn't matter if it's real estate or commodities or whatever. If there's no trend, prices are flat, you're not going to make any money. So we have to understand trend. What causes trend? And I, in my mind, think of it this way. Trend is a function of time. The more time you have in a trade, the more trend move you can get. And that's the trouble with day trading. When I'm not interested in day trading, I've got 3-4 hours, just no time. I've already limited how much I can make because I'm going to be out at the end of the day. I can't catch a really big move. The Bill Meehan, who was my mentor 40 years ago, 50 years ago, said, Larry, the way you make money in this business is to have a small position and catch a large move. If you have a small position, your loss will be small and you can catch a large move.
Right.
And that's really that's the law of gravity of financial success in the commodity business and speculating, is that time is your ally. Time is what allows trend to take place. So I can get a big trend move. I don't have to have a big position on to make a lot of money. I can have a relatively small position, a big move, and if I'm wrong, I'm going to stop that with a relatively small loss. So it doesn't. You apply that rule. Obviously, if you look at a daily chart, almost all large range days close on their high or their low. So you want, if you're just a day trader, you don't want to try to get in and out this oscillator, that oscillator. If you get a big move going, hold on to the thing because it's probably going to close on the higher day. Most of the time, just look at the charts. Don't take my word for it. That's how markets actually trade. That's a cycle, a price cycle. So yeah, the longer I can hold on to a position, the better. So probably the best way of doing that is some type of a trend following mechanism. Or if you're really good, like my buddy Tom and Mark, Tom's got great profit points, targets that he has. I got a few, but he's much better at it than I am. So either a tight trailing stop of some sort or a profit target objective will allow time to become your ally.
Very good. Yeah, that's that difference between time in the market and timing the market, right? So that getting that time in can allow you to participate in those trends when they arise.
Trend is a function of time. The more time, the more trend, the bigger your profits can be. And it's unequivocal. It's the law of gravity.
Excellent. Well, Larry, I wonder if we've got one more question here, which is a simple one, hopefully, and then I'm going to let you get back to everything else you're doing out there in the Virgin Islands. And so this is related to the price. I'm sorry, to the exits that you were talking about a second ago. Thiru asks what sort of methodology do you use on your exits? So we talked a lot about cycles, but how do you get out?
A trailing stop.
Trailing stop.
Or targets.
Okay.
So I have two options because I don't always get to the targets. So I may have a target, we may not get there, we may, but I have to have a trailing stop. So if we fail hitting the target, I come down before the mark comes down a lot. So those are my two exit techniques: a trailing stop or target in the market.
Great. And just a quick follow-up: is that trailing stop based on any kind of mathematical mechanism?
Yes,
or is it okay?
No,
as opposed to market structure, it's not a structural thing where you're manually trailing?
It's a mathematical line based on market structure.
Great. Okay. Well, Larry, thank you so much. We've kept you longer than we said, so I appreciate you sticking with us. It's been a really fun for me to chat to you, and thank you so much for sharing these charts with us as well, and everything else from today.
Thank you. It's always a pleasure to do it. I hope that I've added some understanding of the markets to people, and if I can do that, then it's been a great day for me as well.
Great. Well, no, you certainly have for me, and I'm sure for much of the audience as well. And I apologize to some of the guests tonight. I couldn't get to all of the questions. I did my best to kind of scroll through and try to answer some of these as we went. But Larry, just one more time, thank you so much. For other STA members, the next meeting will be in middle of December. I can't remember the date off the top of my head, but you'll see the emails come out. It'll be the AGM combined with just Christmas drinks. It's the sort of end of year drinks party. Larry, would have you along if you were over here, but I think you might be enjoying the weather over there or skiing, which both sound pretty good to me.
Probably so. Well, until next time, good luck and good trading to everybody.
Great. Thank you everyone for attending, and we'll see you all next time.